All right, welcome back to the Deep Dive. Today we're going to be taking a look at StoneCo's Q4 2024 earnings call. It seems like it was a pretty good one for them, with their adjusted net income growing by 18% year over year.
Yeah, no, absolutely. It really does seem like a solid ending to the year for them. Despite kind of a shaky macroeconomic picture globally, StoneCo seems to have really kind of weathered the storm and even come out even stronger. It really shows, when you listen to the earnings call, it really shows that they're seeing growth in those important areas and they're getting even more efficient as a company.
Yeah, I think you're right about that. So let's jump into some of the specifics. So they reported that their adjusted EBIT, which is earnings before interest and taxes, grew by 22% year over year, which is pretty solid. Mm-hmm. And their adjusted net income, as we mentioned, was up 18%. Their profitability also got a boost, with their adjusted net margin rising to 18.4%, which is a full percentage point higher than it was in Q4 of 2023.
Yeah, and I think what really jumps out when you look at the numbers is the increase in their adjusted basic earnings per share. That's the EPS. And that number saw a pretty significant jump of 26% year over year. That actually outpaced their net income growth, and you can thank their share buyback program for that. It just goes to show how effective buybacks can be in boosting that per share value for investors.
Right, it really does. And looking at the top line, their revenue also showed a pretty healthy bump. They had an 11% increase in total revenue for the quarter compared to the same period last year. And that increase was driven by both adding new customers and, maybe even more importantly, increasing the amount of business they're doing with each customer. So their efforts to expand their services and offer more to their clients, that's really starting to show results.
Yeah, definitely. And when you dig into their gross profit, which is what you get when you subtract the direct costs of their services from their revenue, that hit BRL 1.7 billion. That's a 13% increase year over year. And what's really interesting here is that the gross profit grew faster than their revenue did. And the reason for that, well, it looks like they had lower loan loss provisions and they managed to reduce their funding costs. So that really tells you that they're getting more efficient at managing their operations, and that's a good sign for the long term.
Yeah, absolutely. So now let's zoom in on their different business segments. Starting with the small and medium-sized business segment, that's MSMB, they saw a pretty impressive 19% jump in their active clients compared to last year. That brought their total MSMB clients to 4.1 million, which is pretty huge.
And it looks like that growth is actually accelerating. They added 157,000 new clients just in this past quarter, which is up from 108,000 new clients in the quarter before that. And they gave some credit for that growth to their end-of-year campaigns. So it seems like their marketing efforts are really working to pull in new customers.
And here's something I found really interesting. The percentage of their MSMB clients who are considered what they call heavy users, meaning these clients are using a broader range of StoneCo services. The bundled services, that number jumped from 34% to 37%. That's a pretty significant increase, especially in just one quarter.
Yeah, it is. And what that tells me is that their strategy of offering this integrated suite of services, it's working. When more clients are using more of their services, it really deepens the relationship with StoneCo. They're getting more embedded in that ecosystem, and it makes it harder for them to leave and go to a competitor.
Right, exactly. So looking at the money flowing through their systems, the total payment volume, or TPV, for their MSMB clients went up by 21% year over year. If you break that down, their card transactions grew by 13%, and PIX, which is Brazil's instant payment system, that's continuing to see really rapid growth.
Yeah, and PIX is definitely something to keep an eye on. While it might be pulling some volume away from traditional card payments, StoneCo's been pretty proactive about building new features and services around PIX. And importantly, they mentioned that they are finding ways to make money from PIX transactions that happen within their platform. So it seems like they're turning that challenge into an opportunity.
Absolutely. And despite all that volume growth, they also managed to squeeze out a little bit more from each transaction. Their take rate, which is essentially the percentage they earn on each transaction, that went up by 11 basis points year over year. There was a slight dip compared to the previous quarter, but as they explained, that's pretty normal for the fourth quarter.
And, it's worth noting that going forward, management said they're going to be focusing more on gross profit as their key metric and a little less on take rates. The thinking there is that gross profit gives a much better overall picture of how well they're monetizing their payments, their banking, and their credit services, especially as they plan to start using their growing customer deposits more for funding.
Right, that makes sense. And speaking of banking, That's a segment that saw some really impressive growth. Their active banking clients jumped by a whopping 46% year over year, which brought them to a total of 3.1 million banking clients. That's even faster growth than they saw in their payments client base, which is pretty impressive.
Yeah, and that really highlights how well their strategy of integrating banking services into their core offerings is working. It's just so convenient for their clients to have all their payment processing and their banking needs met in one place. It's a really smart move by StoneCo.
Absolutely. And their customer deposits also saw a big jump. They increased by 42% year over year, reaching BRL 8.7 billion. Now, we know that the fourth quarter usually sees a bit of a seasonal bump in deposits, but the overall trend is pretty clear. Deposits are growing faster than transaction volume, and that's a good sign for their banking business.
Yeah, and within those deposits, their time deposits, those are kind of like certificates of deposit, they grew incredibly fast. They were 3.6 times larger than the year before, hitting BRL 430 million. That growth was largely fueled by their savings solutions, which are clearly resonating with their customers.
And now, here's a really interesting strategic move they discussed. StoneCo plans to convert a big chunk of their remaining deposits, and that's about BRL 8.3 billion, into these on-platform time deposits by issuing certificates of deposits. So can you explain the thinking behind this move?
Yeah, so the main goal here is to strengthen their financial structure and bring down their funding costs. By using these deposits as a source of funding, they can rely less on more expensive ways of borrowing money. Now, they did mention that this is going to slightly reduce some of the revenue they were earning on those deposits previously, but overall, they expect that this move will boost their profitability in the long run.
Got it. Makes sense. So moving on to their credit business, their loan portfolio hit BRL 1.2 billion. That's a 31% increase just in this past quarter. The majority of these loans are working capital loans for small businesses, with a smaller portion going to credit card offerings.
And even though the economic outlook is a bit uncertain right now, they still see lending as a big opportunity for growth, especially because they're currently only lending to a small fraction of their existing customer base. So there's a lot of room to expand. But of course, they are being cautious about how this uncertain economic environment might affect their lending going forward.
And in terms of the quality of those loans, their non-performing loans, which are loans where payments are past due, those stood at 2.47% for loans that are 50 to 90 days past due, and 3.61% for loans that are over 90 days past due. Now, they do expect those numbers to tick up a bit as their loan portfolio matures, which is kind of normal, but what do you think about those numbers?
Well, what's really encouraging is that the amount of money they're setting aside to cover potential loan losses, that's actually been decreasing. For their working capital loans, that fell to 12% this quarter, which is down from 14% in the previous quarter, and it's way down from 20% a year ago. And their coverage ratio, which is the amount they've set aside compared to their non-performing loans, that's still very healthy at 331%. So that tells me they're taking a pretty conservative approach to managing risk, which is always a good thing in the lending business.
Yeah, no, that's definitely a good sign. So let's shift gears now and talk about their software segment. It seems like their strategy of selling financial services to their software clients, that's gaining some real momentum. They highlighted that the overlap in card transaction volume between their software clients and their payment processing clients, that grew by 20% year over year, which is actually faster than their overall card transaction volume growth.
Yeah, and that's a strong indicator that their integrated approach is working. By offering financial services to their existing software users, they're not just creating new revenue streams, they're also deepening those client relationships and making them even more valuable.
Right, exactly. And their software segment on its own saw a 15% bump in revenue compared to last year. Now, that did include a one-time revenue boost of BRL 8 million, and there was also strong performance from one of their software companies called Hekla. But even taking those factors into account, it was a solid quarter for software.
Yeah, for sure. And what's even more impressive is how much the profitability of their software business is improving. Their adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, that grew by a huge 54% year over year. And they achieved a record profit margin of 21.6%. So it's a result of both those higher revenues we talked about and also their continued efforts to make their operations more efficient.
That's really impressive. But there was one notable item in the software segment that we should mention. There was a BRL 3.6 billion charge related to goodwill impairment. So can you unpack that for us. What does that mean exactly?
Yeah, so this is basically a non-cash accounting adjustment, and it doesn't actually affect their adjusted earnings. It means that they've lowered their expectations for the future growth of their software businesses, and they're writing down the value of those assets on their books. They attributed this partly to a tougher overall economic environment, so it's kind of like admitting that an asset isn't worth as much as they originally thought it might be.
Right, that makes sense. And they also mentioned that they explored the possibility of selling off their software assets, but they didn't receive any offers that they felt truly reflected the value of those businesses. So given that, what's their plan going forward?
Well, their plan now is to focus on maximizing the value of those software assets independently, and they're going to continue pursuing that strategy of cross-selling financial services to those software clients. The key takeaway here seems to be that they no longer believe they need to own these software businesses outright to effectively sell their financial services to those customers.
Makes sense. So now let's dig into their costs a bit. The cost of providing their services, that went up by 10% compared to last year. But here's the good news. It actually decreased as a percentage of their revenue. So what drove that improvement?
So that improvement in efficiency was driven by a couple of things. First, they've gotten better at managing their operations and keeping costs under control. And second, there was a reversal of some previous provisions, which offset some of the increased loan loss provisions they had to take because of the growth in their credit business. So it really shows that they're getting a handle on their expenses as they grow, which is really important.
Absolutely.
Yeah.
And their administrative expenses actually went down slightly year over year, which is another good sign that they're keeping a tight rein on costs. However, their selling expenses did increase. So what's the story there?
The increase in selling expenses, that was mainly because they're investing in building out their specialized sales teams. This is a strategic move to drive growth in those key areas, and it's really important for supporting their efforts to cross-sell those financial services.
Right, got it. And their financial expenses also increased, which is something we're seeing a lot of companies dealing with. They pointed to the higher interest rates in the market as the main culprit there. But they did mention their plans to use their growing deposit base as a source of funding. And they think that will help to lessen the impact of those rising interest rates going forward.
And that's exactly where their strategy of converting those customer deposits into those on-platform time deposits really comes into play. It's a direct way for them to try to counter the pressure from those rising rates by using their own funds, which are obviously much cheaper.
Absolutely. And another positive development is their effective tax rate, which actually decreased quite a bit to 14.5%. So what were the main drivers of that decrease?
Well, the lower tax rate was mainly due to gains from their international operations, including the impact of their bond repurchase and the transfer of the remaining portion to a local entity, and that provided them with some tax advantages. And on top of that, they also benefited from some tax incentives here in Brazil.
Right. So now, shifting over to capital allocation, they reported that their adjusted net cash position was BRL 4.7 billion at the end of the quarter. Now, that's a slight decrease from the previous quarter, and that's mainly due to their share buyback program.
Yeah, they've been pretty active with their buyback program. They have an active BRL 2 billion share repurchase program in place, and they repurchased a significant amount of shares in the fourth quarter of 2024. They bought back BRL 608 million worth of shares, bringing the total for the year to BRL 1.6 billion. So they're clearly putting their money where their mouth is when it comes to returning value to their shareholders.
Yeah, no doubt. And they also mentioned that they've calculated that they have over BRL 3 billion in excess capital, considering their financial strength and their current cash position. So what are they planning to do with all that extra cash?
Well, their plan is to return that excess capital to shareholders over time, as long as they don't see more attractive investment opportunities to fuel growth. And those share repurchases they've been doing, those are a part of that strategy.
So looking ahead, what are they expecting for the future? For 2025, they're forecasting adjusted gross profit to be above BRL 7.05 billion, which would be a healthy 14% increase from this year. And for adjusted basic EPS, they're projecting that to be above BRL 8.6 per share. That would be an 18% year-over-year increase. But it's worth noting that their EPS forecast is based on a specific number of shares outstanding.
Right, and importantly, that EPS guidance doesn't factor in any future share buybacks beyond what they've already done. So if they continue to buy back shares, which they've indicated they might, that could actually boost their EPS even higher than their current projections.
Yeah, that's a good point. And looking even further out, their targets for 2027 are pretty ambitious. They expect their MSMB transaction volume to exceed BRL 670 billion, which implies a compound annual growth rate of over 14%. And they're projecting that their adjusted gross profit will surpass BRL 10.2 billion with a CAGR of over 18%. And finally, for adjusted basic EPS, they're aiming for that to exceed BRL 15 per share, which would represent a KGR of over 27%.
Yeah, those are some aggressive targets, but it shows that they're really confident in their ability to keep growing their business at a fast pace and also to keep improving their profitability. And the fact that they're now giving guidance on total MSMB transaction volume, including PIX, well, that just reflects how the payments landscape is evolving in Brazil.
Right. So we'll talk a little bit about their pricing strategy. They decided to hold off on raising prices in the fourth quarter of 2024 because of the holidays, but they did implement a pretty significant repricing at the start of the first quarter of 2025. So tell us about that. What were the details?
So the repricing affected a large portion of their Stone client base, and it's interesting that they saw record low levels of customer churn as a result. So that suggests the price increases were pretty well received by their clients. And they explained that the main driver for the repricing was to align with expected future interest rate trends. They also mentioned that they're going to be reassessing their pricing again by June 2025, depending on what happens with market conditions.
Right. And they also pointed out that the broader industry is starting to focus more on profitability through repricing, which could signal a shift in the competitive landscape.
Yeah, I think you're right. It seems like there's a movement away from just chasing growth at all costs, and there's a renewed emphasis on building sustainable profitability. And that could be a good thing for the industry overall.
Yeah, I think so too. Now, on the topic of returning capital to shareholders, they've bought back over BRL 2 billion of their own shares in the past year, which is pretty substantial. But they haven't announced any specific targets yet for how they're going to allocate capital in the future, whether that'll be through more buybacks or potentially dividends. So what are your thoughts on that? What's the outlook there?
Well, they've said that they're going to provide more details on their future capital allocation plans in the coming quarters. So we'll have to wait and see. But for now, they still have about BRL 900 million available under their current share buyback program.
Okay, so we'll be watching for that. So what do you see as the key factors driving their continued growth in the banking segment?
Well, their success in bundling those payments and banking solutions, that's been a major driver. And they're also constantly developing new banking services to address the evolving needs of their clients, things like payroll solutions and investment products. And based on their comments, it sounds like they expect that their deposit base will continue to grow faster than their overall transaction volume.
Okay, and just to kind of recap their software strategy, their main focus now is on using their existing financial services sales channels to cross-sell to their software clients.
Yeah.
And they've basically said that they don't see owning those software assets as essential anymore.
Right. So it seems like they're going to focus on maximizing the standalone value of those software assets, but they'll also continue to leverage them to grow their core financial services.
All right. And finally, how are they approaching credit risk, especially in light of the current economic climate?
Well, they were proactive about it. They adjusted their credit risk models at the end of 2024 to take into account the more challenging economic environment. And that's part of the reason why their loan loss provisions stabilized around 12%. They're also adjusting the pricing of new loans, so they're definitely taking a cautious approach, but they're still optimistic about growing their loan portfolio in 2025. They see a lot of potential there, but they're also being very careful and keeping a close eye on how those different loan cohorts are performing.
Okay. And one last detail before we move on. They decided to provide guidance on basic EPS for 2025 instead of fully diluted EPS. So why did they do that? What was the reasoning there?
They explained that calculating fully diluted EPS can be tricky because there's a lot of volatility that can come from things like performance-based stock units and the accounting impacts of IFRS losses. And they wanted to avoid the possibility of double counting those non-adjusted share-based compensation expenses.
Gotcha. So overall, it seems like StoneCo is really firing on all cylinders. They had strong results in 2024. They're adapting well to changing market conditions, and they've got a clear plan in place for future growth and creating value for their shareholders. They seem very focused on profitability, using their capital efficiently, and leveraging their integrated platform. So I think they're in a really good position.
Yeah, I agree. I think this earnings call definitely painted a positive picture.
Okay, so now for everyone listening, it's time for our This Is Not Financial Advices segment. Here's a crazy idea for you to consider. StoneCo is buying back tons of their own shares, and they're projecting really strong earnings growth. At the same time, everyone in the Brazilian market seems to be talking about potential interest rate cuts down the line. So here's a highly speculative trade idea. You could go long on StoneCo, that's STNE, and at the same time, you could short a basket of Brazilian banks that might be more sensitive to those interest rate reductions. The idea here is that StoneCo's earnings growth and buybacks could potentially outperform the broader market, even if things get a little bumpy. And lower interest rates, while they might hurt bank margins, could actually stimulate more economic activity, which would benefit StoneCo's payment and lending businesses. But just a big caveat here. This is a really high-risk, high-reward scenario. It's definitely not for the faint of heart, and there's always the potential for significant losses. And as always, we have to emphasize that this is just a hypothetical scenario.
We're just throwing out ideas here, so please do your own research before making any investment decisions.
Yeah, that's definitely a wild one. So what do you think about StoneCo's overall strategy and their future prospects? We'd love to hear your thoughts. Be sure to do your own research and form your own conclusions. And we'll be back soon with another deep dive.
Thanks for listening.